What if the market wasn't a machine? What if it wasn't logical, wasn't efficient, wasn't even real in the way we thought? Imagine stepping into a grand hall of mirrors. Everywhere you turn, there's a reflection. But each reflection is warped, twisted by the curve of the glass, by the angle of your gaze, by the very act of you looking. That's the financial market, according to George Soros. Not a place of objective truth, but a psychic carnival where belief shapes reality and perception becomes prophecy. You're not watching the market. You're watching everyone watching the market. The result? Illusion compounded by conviction. Delusion driven by desire. And when it all snaps, that's when empires fall and fortunes are made. They called Soros many things. The man who broke the Bank of England, a villain to nations, a savior to theories. But what he really did was walk through that hall of mirrors and see something no one else did. He didn't trust what he saw. He questioned it. Then he bent it to his will. This isn't just a story about money. It's a story about psychology, about chaos, about how being wrong could make you rich and being certain could bankrupt you. And if you've ever stared at a candlestick chart and thought, why does it never make sense? This video might be the key to unlocking it all. Because once you see the mirror, you can start to control what it reflects. Welcome to the channel. This isn't financial advice. This is financial reality distortion. Based on George Soros' most dangerous and misunderstood ideas, The Alchemy of Finance, this video is not a summary. It's a transformation. We've reshaped the book into a hypnotic journey through 20 mirrors, each revealing how truth breaks and profits form in the distortion. By the end, you'll never look at the market or yourself the same way again. The market is not a sober judge of value. It's a drunk painter smearing impressions across a canvas called price. And yet, most investors treat it like a sacred oracle. They look at the stock ticker and believe it tells the truth. But what if that truth is only the sum of everyone's hallucinations? At the heart of George Soros' worldview is a dangerous idea. Markets are not merely reflective, they are participatory. In other words, they don't just reflect reality, they shape it. Like a drunk looking into a mirror, the market sees a version of itself and stumbles toward it, mistaking distortion for direction. Here's how it works. Investors see prices moving up. That upward movement creates confidence. Confidence triggers buying. Buying moves the price even higher. Now, suddenly, the price has nothing to do with intrinsic value. It's just a feedback loop of belief, feeding on belief. The mirror has gone mad. Soros didn't just theorize this, he bet on it. In the late 1970s, he began to see that global markets weren't responding to fundamental data. They were reacting to each other. Political fear in one region could ripple irrationally into another. The market was behaving more like a mood ring than a calculator. He used this insight to make asymmetric bets. Not on data. On distortion. On the idea that people weren't just wrong, they were predictably wrong, in cycles. He could see the crowd's reflection before they could. And because of that, he could get out before the crash, or ride the wave before anyone even knew it was forming. What the author really means is this. If you trust the market to tell you what's real, you've already lost. The market is a mirror, but it's not reflecting the world. It's reflecting the emotions, beliefs, and herd behavior of the people looking into it. So now the question turns to you. Have you ever chased a rising stock, believing it must continue simply because it already has? Have you ever panicked when prices dropped thinking, the market must know something I don't? That was the mirror fooling you. That was the reflection pulling you in. But what if from now on, you stopped believing in the mirror and started studying its distortions instead? Because this is just the first reflection. The next one is where the mirror starts turning back on itself. What if the market didn't just react to the world, but actually created the world it reacted to? This isn't metaphor, it's reflexivity. And it's the snake that devours itself in an endless loop. Soros called it the most misunderstood idea in economics. Reflexivity isn't just feedback. It's a vicious cycle where perception alters reality, and then that new reality feeds back into perception. It's as if the market forms an opinion, acts on it, and that action then reshapes the very facts that opinion was based on. Like a snake chasing its own tail, the movement never stops. Let's break this down with a true story. In the early 1980s, Latin America's debt started rising. Investors believed those countries might default. So what happened? They pulled their money out. That capital flight weakened the currencies. Weaker currencies made it harder to repay debt. That justified the original fear, and now default was more likely. The belief caused the outcome. That's reflexivity. Belief becomes behavior. Behavior becomes environment. Environment reshapes belief. And around it goes. Soros didn't try to fight this loop. He used it. He'd find where perception and reality were beginning to spiral together, like the early rumblings of a financial tornado, and then position himself right at the edge, where the wind first began to bend facts, where belief hadn't yet become consensus. That's where prophets live, at the edge of collective delusion. What the author is truly revealing here is that economics is not physics. It's psychology. There's no gravity pulling stocks back to fair value. There's only narrative, emotion, feedback. And if enough people believe something, even if it's wrong, it can become temporarily right. Think of housing in 2006. People believed housing always went up. Banks acted on that. Loans flowed, prices surged, which validated the belief. It wasn't until the loop snapped under its own weight that reality came crashing back. By then, the snake had eaten itself alive. Have you ever believed something about the market, then changed your belief because of what the market did? That's reflexivity working through you. The mirror doesn't just show you, it rewrites you. But here's the secret Soros uncovered. The first one to see the loop wins. Because once you're aware the snake is biting itself, you can predict when it will choke. And in the next mirror, we'll follow a man who did just that, not with theory, but with billions on the line. Most traders hunt patterns. Soros hunted meaning. While others chased numbers and charts, he chased truths. Not just economic truths, but human ones. That's because before he was a billionaire, he was a philosopher. And that's what made him deadly. Born in Hungary, surviving Nazi occupation, fleeing communism, Soros didn't enter finance to get rich. He entered it to test his ideas. His mentor, Karl Popper, taught him that all knowledge is flawed. That we never truly know anything. We only form hypotheses, which must be tested and often proven wrong. Most traders hate being wrong. Soros thrived on it. Every trade was a question, not a conclusion. He carried a notebook, not to track prices, but to write down his evolving beliefs. He would say things like, "I'm long the dollar, but I don't believe in it." Or, "This trade feels wrong, which means it might be right." To most people, that sounds like madness. To Soros, it was clarity. He didn't try to beat the market with certainty. He danced with his own doubt. Let me tell you a moment that captures this. In the 1980s, Soros had a trade going well. Everything said, hold. The data was solid. But something in his back started to ache. A real, physical pain. He couldn't explain it. So he reversed his position. Days later, the market collapsed. That pain? He called it his subconscious warning system. Was it superstition? Maybe. Or maybe, as a philosopher, he knew that the body often feels what the mind can't yet articulate. What the author really means here is this. The best traders aren't just analysts, they're thinkers. They question themselves more than the market. They don't seek perfection, they seek awareness. Soros wasn't trading to be right. He was trading to understand. And this is a radical departure from what most investors do. Most build models to predict. Soros used models to provoke. Most treat losses as failure. Soros treated them as feedback. Most fear complexity. Soros welcomed it, because reality is messy, and the only edge is embracing that mess. So ask yourself, are you trying to be certain, or are you willing to be curious? Are you building models to feel safe, or to reveal when you're wrong? Because in the next reflection, we'll step into one of the most paradoxical powers Soros discovered. How being wrong can be your greatest weapon. What if the secret to winning in the market was knowing you're wrong before anyone else does? In Soros's world, certainty is the enemy. The moment you believe you've figured it out, the market, the economy, the trend, you've already begun to lose. Because that belief blinds you to change. It locks you into one interpretation while the world moves on. And in a hall of mirrors, the only thing more dangerous than confusion is confidence. Soros called this fallibility. Not as a flaw to overcome, but as the foundation of his entire method. Most investors seek systems. He embraced error. Most try to eliminate emotion. He mined it. His genius wasn't in predicting the future. It was in predicting when his own ideas would fail. He treated his mind like a broken compass, always pointing somewhere, but never quite true. And because of that, he never stopped checking the map. Hindsight is seductive. It smooths chaos into clarity. It turns guesses into genius. And worst of all, it makes you think you can do it too. There's a journal entry Soros wrote that reads almost like a confession. I am frequently wrong, but I change quickly. That wasn't weakness. It was agility. It was survival. In markets, rigidity kills. Admitting you're wrong fast? That's a profit strategy. One story that proves this. In 1985, Soros was convinced that the dollar would rise. He loaded up his positions. At first, the market agreed. Then it stalled. Then reversed. Most fund managers would have clung to their thesis, waiting for vindication. Soros? He flipped. Completely reversed his bet. Not only did he avoid loss, he profited more from being wrong than most do from being right. That's the wisdom bomb here. Being wrong is not the problem. Staying wrong is. The greatest investors aren't those with the best models, but those with the best relationship to error. And in a world flooded with hot takes, overconfidence, and echo chambers, this mindset isn't just useful, it's revolutionary. Especially in 2025, where AI and social media amplify false signals at lightning speed. Fallibility isn't humility, it's power. It's the willingness to throw out your map and redraw it every morning. So ask yourself, when was the last time you admitted you were wrong in a trade and changed instantly? Or do you dig in, looking for reasons to justify your bias? Because in the next mirror, we'll witness the moment Soros used this philosophy to do the unthinkable. Shatter a nation's financial pride with one legendary move. It was September 16, 1992, a day that would forever be called Black Wednesday. The British government was desperate to keep its currency stable. Billions were on the line. National pride was at stake. Central bankers promised strength, confidence, and unshakable policy. And then one man shattered it all. George Soros didn't just short the pound. He shorted the very idea that a government could defy the mirror. Here's what happened. The UK was part of the exchange rate mechanism, an agreement to keep the pound within a tight trading range against the German Deutsche Mark. But there was a problem. Britain's economy was weakening. Inflation was rising. And to defend the pound, the Bank of England had to keep interest rates high, too high for a country slipping into recession. Soros saw the crack in the mirror. The image the government projected of a stable, powerful currency was just a reflection, not a reality. Behind that glass was a fragile system held together by politics, not fundamentals, and he knew reflexivity would strike. Once people believed the pound couldn't hold, they'd sell. The selling would weaken the currency. The weakness would force the bank to defend. The defense would cost billions. And eventually, the mirror would break. So he bet against it. Hard. Over $10 billion, in fact. The British government tried everything. Raised rates, spent reserves, made public statements. But Soros was already on the other side of the mirror. He'd seen through it. He knew belief was shifting, and nothing would stop the cascade. By the end of the day, the UK withdrew from the ERM. The pound collapsed. And Soros walked away with over $1 billion in profit. But the deeper truth? This wasn't a lucky trade. It was a philosophical play. He didn't just see the numbers. He saw the narrative unraveling. He saw how the illusion of control becomes its own downfall. What the author really means here is that markets are not governed by governments. They're governed by perception. And when perception turns, no authority, no institution, no legacy can stop the flood. Now ask yourself, do you believe in systems just because they're backed by power? Do you assume that a nation's word is unbreakable? Because sometimes, it's the individual who sees the distortion that holds all the leverage. And if one man can break a currency with insight, what could you break if you learn to see what others ignore? Next, we step deeper into the mirror, to the point where confidence becomes mania and boom turns into bust. Every boom starts as a whisper, a subtle shift in belief, a soft echo of confidence that grows louder with repetition. Until suddenly, the entire market is screaming a single word, "This time is different." George Soros didn't just trade bubbles. He listened to them. He treated each one like a living organism, breathing, expanding, mutating, and then, inevitably, bursting. But unlike most, Soros wasn't obsessed with the pop. He studied the buildup, the whispers before the roar. One of his most revealing case studies was the Japanese asset bubble of the 1980s. Real estate prices in Tokyo rose so high, people joked that the Imperial Palace was worth more than all the land in California. Stocks soared beyond fundamentals. Bankers praised the economic miracle. But Soros saw something else. A self-reinforcing fantasy. Prices rose, so confidence grew. Confidence brought capital. Capital inflated prices further. The mirror loop was in full effect, and yet no one wanted to leave the party. Governments denied danger. Economists redefined value. Investors remortgaged their souls. But Soros, the philosopher, saw the fatal flaw. Reflexivity had detached from reality. The mirror no longer bent truth. It erased it. So he stepped aside, watched it unfold. And when it collapsed, the fallout lasted a generation. Here's the wisdom bomb. Bubbles are not financial errors. They are psychological inevitabilities. They don't begin in data. They begin in desire. In the human hunger for certainty, for progress, for invincibility. Soros understood this because he didn't see markets as machines. He saw them as mobs with calculators. In today's world, with meme stocks, AI-generated hype, and influencer-driven sentiment, the echo chamber is louder than ever. One viral video can inflate a stock 300%. One influencer's tweet can spark a short squeeze. The 2025 bubble landscape isn't driven by spreadsheets. It's driven by screens, narratives, and millions of tiny emotional trades. So ask yourself, can you hear the whisper before the roar? Can you feel when confidence becomes cult? Or are you just another voice in the chorus, unaware you're part of the crescendo? Because in the next mirror, we'll break down the exact rhythm of that crescendo. How Soros decoded the boom-bust cycle into a blueprint for predicting collapse. Most people think crashes are surprises. Soros knew they were scripts, played out again and again by the same actors, wearing different masks. And if you knew the rhythm, you didn't just survive them. You danced right through the wreckage. He called it the boom-bust cycle, and he didn't just observe it. He mapped it. A psychological arc masquerading as economics. It always began the same way. A new idea, a fresh narrative, some shift in policy or technology or trend. The belief was small at first, but belief grows like fire when it's fed attention. Investors begin to pile in. Early gains validate the thesis. Confidence becomes momentum. Momentum becomes greed. And then, it crosses the tipping point. That point is key. It's where the narrative detaches from reality, where reflexivity accelerates. People stop analyzing and start echoing. The market becomes an amplifier of its own desire. Price rises not because of value, but because of the expectation of more rise. This is where Soros thrived. He didn't short bubbles early. He rode them. He surfed the wave until he felt the air thinning, until the loop was too tight to sustain. And then, he turned. Fast. Because busts move quicker than booms. Once reality breaks through the fantasy, panic spreads like wildfire. The same reflexivity that fueled the rise now fuels the collapse. Selling begets selling. Fear chokes liquidity. Institutions freeze. And the final crash always seems unexpected to those still inside the mirror. One of his clearest executions of this cycle came during the 1997 Asian financial crisis. Thailand, South Korea, and others were booming. Hot money was flowing in, currencies were pegged, confidence was sky high. But Soros saw the same script. When debt became unsustainable and political instability grew, he knew the loop was about to invert. He positioned early. And when it unraveled, he was already counting profits. What the author is really offering here is not a forecast, it's a frame. The market is not chaos, it's choreography. Emotion has a tempo. Narratives have seasons. If you can spot the rhythm, you don't need to predict the news. You just need to feel the beat turning. Have you ever noticed that just when everyone agrees, that's when it all falls apart? That's not coincidence. That's the climax of the cycle. The point of maximum illusion. The final mirror before the shatter. And speaking of mirrors that lie, what happens when the data itself starts distorting? When fundamentals betray the very traders who trust them, it's the ultimate betrayal. The moment you trust the numbers and they stab you in the back. Investors are taught to love fundamentals. Revenue, earnings, balance sheets. Clean, rational data. But what happens when that data becomes distorted? When the very metrics that once grounded you become illusions inside the mirror? George Soros warned of this seduction. He called it the Judas signal, the false friend that leads you into danger while whispering promises of safety. In a reflexive market, fundamentals don't just reflect reality, they're shaped by market behavior itself. And that means the data you're reading might already be infected by the perception you thought it would clarify. Take the subprime mortgage crisis. In 2006, the data looked solid. Home values were up. Mortgage-backed securities were performing. Rating agencies stamped them AA. But beneath that surface was a rotting foundation of no income, no verification loans, hidden leverage, and mass delusion. Everyone was using the same data to justify their positions. But the data was based on reflexive demand. Prices that only existed because people believed they could only go up. Soros saw it. Not in the spreadsheets, but in the psychology. He noticed how assumptions embedded in the models, default rates, correlation, were based on stable environments that no longer existed. The very metrics had become self-fulfilling lies. And when the market turned, those signals didn't save anyone. They slaughtered them. Here's the real meaning behind this concept. Even the truth can lie when it's wrapped in market psychology. Fundamentals in a reflexive world are not fixed points. They're moving targets, distorted by waves of sentiment, policy, and behavior. What's real today can become fiction tomorrow if enough people believe something else. And in today's world, 2025, where AI models drive trades and news cycles mutate within minutes, where even charts can be manipulated to show favorable patterns, this distortion is accelerating. A company's fundamentals can shift within hours based on viral sentiment or political noise. What was solid becomes sand. So ask yourself, have you ever made a trade based on strong fundamentals, only to watch the market punish you for being logical? That wasn't bad analysis. That was the Judas signal. Because in the next mirror, we'll explore what happens when everyone stares at the same reflection, when the consensus becomes a trap, and the maze of mirrors leads nowhere but back into itself. What happens when everyone looks at the same mirror and thinks they're seeing the truth? This is the danger of consensus. When every analyst uses the same data set, reads the same headlines, watches the same Fed announcements, the market becomes an echo chamber. And in that chamber, the mirrors start reflecting each other, not reality. That's when price detaches not just from value, but from any independent thought. Soros understood this early. He saw the herd not as a source of comfort, but as a signal of danger. When everyone agrees, it's not a confirmation, it's a setup. Because reflexivity means that what everyone believes becomes the basis for behavior, which feeds back into the market, which validates the original belief until it doesn't. The mirror maze becomes a trap. Let's revisit the tech bubble. Late 1990s. Internet stocks soared. Everyone had a thesis. Everyone believed. Even Warren Buffett was mocked for not getting it. But Soros? He made money going with the bubble, and then made money again going against it. Because he saw that the belief in growth had become belief in belief. Valuations weren't based on business models anymore. They were based on what the next person would pay. It's the classic mirror maze trick. Everyone looks for an exit, but all they see is more reflections of themselves. In a world like ours, saturated with information, flooded with opinions, this trap is deadlier than ever. Retail traders mimic influencers. Influencers mimic institutional analysts. Algorithms mimic momentum. Before long, the entire system is trading shadows of shadows. And then one person sneezes, and the whole house of mirrors collapses. Here's what Soros really means. The more people agree, the less safe it is. Not because consensus is wrong, but because in a reflexive system, consensus becomes fragility. The moment the crowd is forced to turn, it tramples itself on the way out. So let's turn the mirror toward you. Are your decisions based on insight or on what everyone else is doing? When you see 10 videos say, buy this stock, do you feel confident? Or do you pause and ask, why now? Because in the next mirror, will strip away the noise entirely and step into a truth Soros mastered. The power of sitting in uncertainty and seeing through the fog when others rush toward the nearest reflection. In a world addicted to answers, the one who can sit with uncertainty becomes a king. George Soros never claimed to know what would happen next. In fact, he built his entire fortune on the opposite principle, accepting that he didn't know, and using that uncertainty as leverage. While others rushed to clarity, he sat in the fog, eyes wide open. It's human nature to crave certainty, to demand predictions, to ask, is this stock going up or down? Is this the top? Should I buy now? But markets don't reward certainty, they punish it, because certainty blinds you to shifts, to nuance, to feedback. And Soros knew the fog wasn't a problem. It was a signal. He once wrote, "I'm only rich because I know when I'm wrong." But deeper than that, he knew that clarity in markets is often a mirage. The clearest narratives are usually the ones most saturated with bias. The fog? That's where you're forced to think, to observe, to respond, not react. During the 1994 bond market crisis, Soros watched as yields surged and bond prices plunged. Everyone scrambled for explanations. Was it inflation? Was it the Fed? Was it geopolitics? Soros didn't pretend to know. Instead, he watched the reaction, the sentiment, the positioning. He moved slowly, not because he was confused, but because he respected the uncertainty. When the picture clarified, he acted decisively. That's the difference. Clarity didn't drive his action, reflection did. What the author is really showing you here is that uncertainty isn't a void, it's a canvas. And the best investors don't fill it with predictions. They sketch outlines, test assumptions, wait for patterns to emerge. They listen to the fog. In 2025, the fog has only thickened. AI-generated news, deepfake data, instant sentiment swings. Clarity is more scarce than ever. But the temptation to rush to action is stronger too. That's the trap. So here's your mirror moment. When was the last time you paused? Not because you were afraid, but because you respected the unknown. Do you wait for confirmation? Or do you trust that sometimes seeing clearly means waiting in the smoke until the light finds you? Because in the next reflection, we face a more modern menace, the noise trap. Where clarity is faked, signals are twisted, and even your own instincts are drowned in a sea of sound. Imagine standing in a room with hundreds of people, all whispering different advice into your ears. Buy, sell, hold, crash, rally. Now imagine those voices are headlines, charts, tweets, and breaking news banners. That's today's market, and most investors are drowning in it. Soros saw this coming long before it became a pandemic of distraction. He understood that the greatest threat to clarity wasn't uncertainty, it was overstimulation. Too much information, too many signals, too much noise. In his trading journals, he often wrote about false clarity. The sensation of feeling informed while being subtly misled. News that sounded urgent but was irrelevant. Analysis that looked logical but was built on circular reasoning. He called it noise with teeth because it doesn't just confuse you, it bites. Take the 2010 Eurozone crisis. Headlines screamed daily updates, bailouts, protests, policy shifts. Investors flipped positions based on morning news and afternoon rumors. But Soros filtered through the chaos. He didn't react to each twist. He studied the underlying pattern, the structural flaws in the euro itself. That's how he positioned himself around the noise, not inside it. The wisdom bomb here is profound. Noise isn't just useless, it's dangerous. Because it creates the illusion of insight. It triggers action without understanding. And worst of all, it drowns out your own voice, the intuition that tells you when something's off. In the age of 2025, where AI bots generate fake analyst reports, where financial influencers can pump or dump with a single livestream, where even charts can be manipulated to show favorable patterns, the noise trap has become a labyrinth, and most are lost in it. So ask yourself, how often do you act on urgency, not insight? Do you chase signals, scroll for comfort, consume news because it feels productive? Soros's answer was simple. The more noise you hear, the less you know. That's why he disconnected. He wrote. He reflected. He questioned. And in the next mirror, will enter his most personal realm, the pages of his diary, where noise is silenced and the internal battles of a trader philosopher are laid bare. Inside George Soros's journals lies something few investors ever reveal: doubt. Not the kind you confess to others. The kind you whisper only to yourself. The kind that lingers between a winning trade and a sleepless night. In his own hand, Soros recorded the chaos, the self-contradictions, the shifting beliefs, the moments of genius, and the crashes of ego that followed. To the outside world, he was a warlock of markets, a man who could bend economic laws with a flick of strategy. But in his private writings, he was something more human, a man in constant dialogue with uncertainty. Each journal entry wasn't a victory lap. It was a post-mortem, a confession, a recalibration. He'd write things like, "I am long the dollar, though I am uneasy about it." Or, "This trade does not make logical sense, yet I feel compelled to act." These weren't signs of weakness. They were signs of depth. He was mapping his own mind, tracking how his beliefs evolved, how bias snuck in, how intuition often beat intellect. Soros treated his inner world with the same scrutiny others applied to balance sheets. Here's the bombshell. He didn't trade from confidence. He traded from reflection. The journals weren't records of past trades. They were mirrors, tools for detecting internal distortion before the market exposed it. There's one entry, just days before he exited a massive position, where he wrote simply, "The logic holds, but something feels off." That something wasn't in the data. It was in his gut. That feeling saved millions. In today's hyper-external market world, where everyone flaunts their wins, screenshots their profits, builds identities on conviction, this inward honesty is rare and powerful, because it's not your bravado that protects you. It's your willingness to interrogate your own illusion. So here's your mirror moment. Do you journal your trades? Not the numbers, but the reasons, the emotions, the uncertainty. Would you dare write your fear before the loss? Would you record your overconfidence before it shatters? Because in the next mirror, we turn from the inner world back to the battlefield, to the illusion that still traps even seasoned traders, the belief that you can control the market instead of understanding how easily it controls you. It's the seduction that ruins even the best traders, the feeling that you can master the market, that with enough data, enough tools, enough willpower, you can bend the waves to your command. But Soros knew better. He learned that the moment you believe you control the market is the moment you've lost touch with it. Control is an illusion. The market doesn't respond to your strategies. It responds to the collective chaos of perception, reaction, error, and surprise. It moves like a living organism, unpredictable, reflexive, often irrational. And the more you try to dominate it, the more you become vulnerable to its feedback. Soros approached the market like a sailor in a storm. He didn't try to stop the waves. He tried to read them, feel them, shift with them. If the wind changed, he changed tack. If a current pulled him sideways, he recalibrated. His gift wasn't control, it was adaptation. In the late 1980s, when his quantum fund was outperforming nearly every other in the world, Soros still made sudden pivots, sometimes overnight. When asked why he'd flip a position that was still profitable, he answered, "Because the world changed, and my job isn't to be right, it's to be aligned." This is the real meaning behind the concept. You can't control markets, but you can control how quickly you adapt to them. The faster you release your ego, the faster you re-enter the flow. In modern markets, 2025 and beyond, the illusion of control is even more dangerous. Algorithms promise precision. AI signals whisper perfect timing. Social trading platforms seduce with the idea that following the herd means safety. But these tools can trap you deeper inside the mirror maze, reinforcing the belief that you're in charge, when really, you're chasing ghosts. Ask yourself, are you trying to predict or trying to listen? Are you holding on to positions because you were right, or because they still make sense in today's context? The truth is, control gives comfort, but kills clarity. And clarity comes only when you surrender the need to steer the market and start moving with it. And in the next mirror, we'll witness how even reality itself, truth, numbers, events, can bend under the pressure of collective belief. When crowds distort facts and facts no longer hold the line, what do you anchor to then? What happens when the facts no longer hold their shape? In the world Soros described and profited from, truth itself can warp under pressure. In a purely rational system, truth would anchor decisions. Prices would reflect value. Data would confirm reality. But in a reflexive system, belief bends truth. Perception isn't just interpretation, it becomes input. We saw it in the global commodities boom of the early 2000s. Oil prices surged, not only because of supply and demand, but because investors believed in a future shortage. That belief attracted capital. Capital fueled speculation. Speculation pushed prices higher, and those new prices? They confirmed the original fear. Suddenly, headlines screamed about scarcity. Policymakers reacted, consumers adjusted. What started as belief became behavior, and behavior reshaped the very truth it was built on. That's reflexivity, not just in action but in epistemology, in how we know what we think we know. Soros once noted, "The prevailing bias influences not only market prices but also the so-called fundamentals that market prices are supposed to reflect." This flips the table. Fundamentals don't anchor prices. Prices can distort fundamentals. Earnings rise because expectations rise. Demand rises because stock prices do. Confidence becomes its own justification. Think of meme stocks. In 2021, GameStop's price detached from reality. But the new price created a new reality. The company raised capital, hired better leadership, opened strategic options. The absurd became a springboard to legitimacy. Even as fundamentals improved, they were born from fiction. What the author is really showing us is that truth in markets is not a still object. It's elastic, stretchable, bendable under emotional weight. The more people believe something, even if it's wrong, the more likely it becomes right enough to act on, until the next belief overtakes it. In 2025, we now live in a world where markets move not only on facts, but on how those facts feel. News is not consumed, it's performed. Algorithms can generate thousands of narratives per second. And when the audience believes the performance, the price responds accordingly. So ask yourself, what are you basing your trades on? Data or belief about data? Are you holding on to something because it's true or because it's true enough for now? Because in the next mirror, we'll explore how that truth, bent, twisted, reshaped, can sometimes rescue entire economies or drag them into ruin. It all depends on who's holding the mirror.